The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots, and I am not joined by the Brain Trust himself. He is, Chase is finishing his academic odyssey. He's tying up, I think he's finishing up his master's degree, actually. Anyway, so he had a meeting he had to go to, but you're stuck with me. So, too bad for you guys. Anyway. Not a lot went on today. Before we get started, we'll run through the indexes. So, let's see. S&P finished down pretty much flat. Let's see. Why is that showing? It's showing down 0.17. The number I was getting, maybe that was after hours, 0.26, whatever. Let's see. NASDAQ down just a little down, basically flat. Funny too, our value portfolio that I run was flat on the day. This looks like one of those, just nothing days where no one's paying attention to anything fundamental. It's just volumes looked a little low. Let me check volumes on, let's see, where are we at on the volume? Let's see. Yeah, super light volume. Shoot, you had about 1/2 of normal volumes today. I'm not sure what to read from that, if anything, but clearly volatility is settling down a little bit. I think what you've got right now is the market still just trying to price everything in. A lot of uncertainty, still a lot of ridiculously overpriced stuff here in the United States. You're still seeing the, one of the best performers I saw today is Palantir. Again, who knows, the way markets resolve themselves or what goes on. I'm not going to be convinced we're through this until I see the nonsense stop, like trying to run Palantir up here. And I could be wrong looking at it that way. Palantir up 6.2% by an upgrade by Dan Ives, who I think is one of the biggest idiots in the world. And I shouldn't say that because he's had some good calls just because it's been a tech environment. You just throw, a dart at the tech board and you've won. But just the guys, when it comes to valuations or fundamentals, the guy's a joke. And he's sitting there making this argument for his price target at 120, 130 on Palantir stock. The thing's trading at 70 times sales right now. In my opinion, I'm going, Dan, you're still wearing a raincoat and it's 90 degrees outside. So you're wrong. I hope he's right though with Palantir, because I would just love, and we might throw a short on it right here at 100. Problem is the chart on it looks decent. And I'm still kind of trying to decide. One of the tough things I think looking at this market is, do you have another BS, ridiculous, nonsensical move in some of these names? Or is the jig up? I'm of the belief the jig is up, but I'm looking at this market and I still see a market full of nonsense. I still see a market full of people thinking that buying the dip in ridiculously overpriced U.S. stocks is the way to go. I don't need to kick a dead horse. You guys know our take on it. I think it's a joke. And quite honestly, I think though, one of the things is funny. We had our investment meeting today, and Marcos, who runs our value portfolio, he currently lives in London, not our value portfolio, our momentum portfolio. And he had a take that was ridiculously similar to kind of the way that I see things shaking out. I think the buy the dip that has been a Pavlovian lesson that has been taught to this market over the last 15 years. I think what that's going to do is disguise what is really happening under the surface. Meaning where I'm looking at this market, I think a lot of people that are all loaded up in all the usual suspects, high flying, ridiculously priced crap. I think that what's going to happen is a lot of what has happened over the last 4 months, right? You go back and look at the last 4 months, market effectively trading flat with a lot of the high flyers that everybody loves, especially the retail favorites, are down and still down substantially. Most of them, meaning double digits. I think that that's a prelude. I look at these things. You're in an environment now where the U.S. is not the only game in town. And to me, that's the only environment where companies like Palantir are going to sustain 70 times revenue. As a matter of fact, I don't think any company will ever sustain that kind of valuation. Not for a long period of time anyway, right? NVIDIA kind of got up into those realms. And I think the experience with NVIDIA is what people are following off with Palantir. And it's such a ridiculous way to look at these things, because Palantir is not going to see a 400% revenue increase over the course of 18 months. Okay. And I'm just of the belief, and this might be too old school and I could be proven wrong. I just think that this nonsense needs to get beaten out of this market. And unfortunately, I think the people that own these things need to get wrecked. Because what you need for this market to really start behaving normally and truly become a price discovery mechanism again is you need those people to get wrecked, right? Like, meaning you've got to get people sober. And I think one style of investing, and the name of the game for the last, for the better part of the last 15 years is take on as much risk as you can and ignore all risk management processes. I think that game has completely changed. The other thing is you're just, that's one of the other crazy things about this environment is, and we've talked about this market being like this, but I will continue to say that I think it is also the most blind market of all time, which shouldn't surprise us. If we're sitting there saying simultaneously, it's not fundamental, we're just buying dips, all that kind of stuff. It shouldn't surprise you that it's blind. What do I mean by it's blind? I continue to look at like a company like Apple and go, I don't know what longs are looking for, not at these prices. I don't know what I cannot for the life of me understand what would prompt you. Again, if it's just tech up and to the right all the time, great, but it's not. I don't think we're there at all. I think that game has changed. And I think you look at what is Apple going to do to be able to perform at a level that is deserving of this multiple? I don't think anything. Right? I mean, is anybody out there forecasting better iPhone sales this quarter than last quarter? If you are, that seems kind of crazy, right? And then you look at how bad the numbers were last year. You look at the fact that last quarter, they even had the advantage of the new AI phone, which was a joke. And for the first time ever, they had a new phone launch, the AI phone, and it undersold the iPhone 15 from a year ago, the quarter a year ago. First time that's happened. So again, I look at so many of these stocks, they're still priced as if the US is the only market in town. It clearly isn't. And what I think is I think you're going to see this market take like 2 steps down, 1 step up, right? These things will get knocked down like they have recently, back to a more, defensible, fundamental position. Now, this is just totally guessing on my part. And the fact that I'm laying it out this way probably means it's the only thing that is not going to happen. So take it certainly with a big old grain of salt. But I just think that this buy the dip mentality is going to cost people a lot more money. And the reason I think that is because they're going to see every one of these pullbacks as an opportunity, not realizing that it's like Tesla, people buying in there trying to run Tesla up at 400 after that last quarter. Well, what it shows you is there's a bunch of uneducated investors in this market. Only an uneducated buy the dip investor could go long Tesla after that last quarter. It was an abysmal quarter. With a reduction of revenue year over year for a company that's trading at 155 times earnings in an industry that trades at 13. Okay. Well, it's robots. Well, it's sort of like the Tesla sport car, right? You still waiting for that thing to come out? How about the semis? I'm not taking shots at Elon Musk. This isn't anti-Trump. I'm just saying you're in an environment now where, in my opinion, just valuations matter. You look at American equities, they're still on crack. Yeah, they've gotten less crack high, right? But I mean, it's still a joke. I mean, you want me to buy a company whose earnings and revenues are flat to slightly negative, and you want me to pay 35 times earnings? Why? When it looks to me like that, those revenues and earnings are going to be under pressure going forward. And not to mention the other, you know what? Look, I've got an axe to grind against Apple. I don't like their products. I think they've gone way downhill. I think at some point their innovation, they quit trying to innovate and they started trying to trap you, right? I look at all of their quote unquote innovations and it's all about trapping you on their platform. They still don't have a functional spell check. It's a joke. It's AI enabled, but you can't run a spell check. Your spell check is as effective as it was 8 years ago. They're just garbage. I hate their cursor on their phone. Their phones get more buggy. They don't last as long. I don't get it. I don't even, I don't, and they're still considered one of the most admired American businesses. Talk about a company that I honestly believe is peaked. Now, at the right valuation, you get me involved, but I'm just saying, like, I look at all these things. It's a more competitive world, and more competitive in terms of where is capital going to flow to, right? And I think that is one of the biggest things that's going to catch U.S. investors off guard, right? They've gotten used to these ridiculous valuations and the way these stocks run. Again, those things can happen when you've got no other competition. Now you've got nothing but competition in markets that have, some of them look to have better growth prospects than the US in the near term. And on top of that, they're trading at like 1/5, 1/6, 1/7 the valuation. So those dynamics are still very much in place. I don't think you've done much to resolve that on the US as far as US markets go. I mean, most things are a little less obscene, but you still see just obscene, ridiculous crap all over the place. And maybe I'm too old school. Maybe markets are different these days. I just don't think that this is going to be over until a Palantir comes back down to earth. Good company, right? Like again, you're just at prices that don't make any economic sense, especially when you look at, for instance, go look at, if you want to know what I'm talking about, go look at a Mercado Libre compared to, now, again, they do different things, not a great comp, but look at margins. Go look at the comps company to company. And it leaves you just scratching your head going, why would I pay up for this? And you shouldn't, right? Palantir isn't where it is because some moron like Dan Ives puts a $120 price target on it, and he offers absolutely zero fundamental research that goes into that, right? What you need to be looking at are at valuations and fundamentals. Because again, I just think that you're looking at vacuum valuations on a lot of these things, meaning, valuations that can only exist in a vacuum where US is the only game in town. And that's just very much not the case anymore. So that's a little bit of a rant there. Let's go back to look at rates have been a little subdued. As a matter of fact, rates have come in a little bit. Where we at on the 10 years down to 4.33. We were up there right around 4.5 last week. So you're getting a little bit coming in here on the long end. 30 years still at 4.7. So you've pulled a little bit. We were testing 5. On the rate side of things, I don't have a whole lot of clarity here. I think that there's some talk and some consternation and some quote unquote fear regarding higher inflation or higher rates. I don't see that. Quite honestly, I kind of feels like it's probably a time to go long duration. And like with everything we say on this show, guys, it's not a recommendation. I just think one of the things that's also getting lost in the shuffle here, and again, we've said this before, but all this tariff talk, it reminds it harkens back to coming out of COVID, right? Where you're just looking around going, I don't understand what you guys are looking at, as it relates to oil and oil stocks. I continue to feel like this market is looking at something across the street when the real action is happening on our side of the street. I mean, they're so focused on tariffs. I'm looking at them going, hey guys, regardless of tariffs, are you looking at underlying economic data? It is not at all supportive of the prices that you've got assigned to and everybody's like looking for the rally. And I'm like, I'm looking at the economy going, I think this economy's got to do some really special things to provide an environment where stocks can maintain valuations, let alone accelerate. I mean, earnings estimates are coming down right and left. I look at the U.S. markets. I see nothing but risk, and risk at very expensive prices. So that really hasn't changed much. And like I said, you've gotten a little less obscene here, but you put me in an environment like this, and I'll just tell you straight out of the gate, with all the different moving parts, I'm not trying to be too cute. I'm buying value, and there's so much of it out there, right, on the fundamental side. Seems like a fool's errand trying to pick whether these things are going to go from 50 to 70 times earnings, even though the underlying doesn't adjust it. And I reference Mercado Libre, classic example, right? What do I mean by that? Go look at their growth metrics. They're growing faster than Palantir. Now, they're not selling to governments, which without question is a mark. And look, I like Palantir. I like Palantir. I think they're a great company that's got great products. I just think they're trading at you're a $230 billion market cap on a company that does $3.5 billion of revenue. I mean, it's absurd. It's ridiculous. So if you get run over owning it, I don't feel bad for you. It's ridiculous. I mean, it's completely uneconomical. It's a joke. But until I see those, and you don't want to boil the market down to one stock, but until I see these things come back down to earth, I'm just not convinced the pain is over. Now, a really interesting thing though, strategy. Now, I'm not going to do this because I'm a risk manager. Yeah, I mean, Carvana back up to 4 times earnings, which is a fraud. But I'm not interested in doing this because of managing other people's money. But I think a game that probably a great trade that's going to be is buying these things, trading these things, right? Trading these ridiculous, because when they get hammered, the buy the dip people are going to come in for no other reason for the fact that they got hammered, right? These people are not looking at balance sheets and income statements or anything. They think they've hot wired the investment game, and you're not going to convince them they haven't until they're out of money, period. So a good strategy might be buying these things after they get hit for 15 or 20%, letting them, let the buy the dippers come in and run it up and then cash it out and play that. Again, not advising you do that, but I do think that's the stage of this that we're at. And then the other thing is, maybe I'm completely wrong. I mean, look at a stock like Palantir. Maybe it's at 200 6 months from now. I don't think it's going to deserve that. I think the chances of them announcing anything that makes that even close to sane is virtually zero. But, clearly people want to pay $10 for a $1 item. So, best of luck to them. I just don't see it. I think to get valuations, and again, guys, I don't think, no, you're at $230 billion market cap on this thing. Good God. Again, with $3.8 billion of revenue currently, trailing 12 month. It's just obscene. And, if you ever heard the old adage of a trading sardine or a buy, if you didn't know what a trading sardine is, pull up Palantir. Carvana fits the bill too. Palantir is they're a real company, not a fraud. So I think Palantir is a much better deal, but the price is it might as well be a fraud in my opinion at this price. The other thing is these idiot retail investors won't go look at the insider stock reports. You look at those Palantir guys, they've been selling that thing. They've been selling stock like it's going out of style. So, but I was bringing up, Mercado Libre, just go do a comp and you look around at stuff like that. And I'll just tell you, you could, like I said, would I be shocked if you told me Palantir got up to 500 billion? No, just people are like, what do you mean? And I'm like, guys, a $500 billion market cap would be just as stupid as 250 billion. Yeah. I mean, if you want to pay more for an asset than it's worth, why not? I mean, why not go for the gusto? Don't be a piker, right? Let's go for, so, I think that $200 a share makes as much sense as 99. I mean, the company is it is impossible for the company over the next several years to perform to a level that's even close to commensurate to that. People, that's what they said about NVIDIA. Well, Palantir doesn't make chips and we're not going to have the relaunch of an AI, right? And if NVIDIA has become your new investment test case, God help you guys, because you're never going to see it again. Okay. You're never going to see a company that large produce that kind of, blow your hair. I probably should say never again, but it's a historical anomaly. You don't make that a base case for investing and look at the valuations assigned to a lot of these things. That's what people are doing. So I just, we're not even bringing interest rates into these conversations. I was listening to a guy talk about, well, if you look at rates, the market's expensive, and I'm looking at him going, buddy, this market hasn't cared about discount rates for a long time. If you think the discount rates have anything to do with the valuation on Palantir, I got a bridge to sell you. Okay. This is just pure buy the dip idiocy. Which, that's Dan Ives. I mean, he's a pig in, what. Let's see what else we have. Gold continues to do obviously incredibly well. Gold was up another 0.5% on the day. No, actually, gold was up 0.68 to new high of 32.48. So we're at 32.50 on gold. Gold miners still performing really well too. GDXJ, the juniors were up about 1.25%. GDX, the regular miners, the senior miners were up. The big boys, majors were up 1% even. And it's really crazy. You know, I was explaining to one of our employees the other day, as good as the run has been here in these gold stocks lately, they've actually gotten cheaper. Especially when you comp it to the movement in gold. And you know, a day like today is a perfect example. Gold up 0.7, okay, the miners up 0.1%. Now, bear with me because none of these things are ironclad, okay? But you got to remember something. Stocks are valued on a multiple of earnings, right? 20 times earnings, 30 times earnings. That's the way we value companies. Okay, when you see gold going up, like a day like today is perfect. Okay, you see gold miners up. Now, this is just one day, but I'm using it as a microcosm to make an example. Gold is up 0.7. GDX mining, you know, the largest gold mining companies, ETF is up 1%. On a day like today, gold miners got cheaper. And people are like, what are you talking about, Zach? Gold's only up 0.7. They're up because they don't get paid dollar for dollar. That's not the way you price companies. You don't price them dollar for dollar, right? You price them on a multiple of earnings. Okay. And when gold goes up 0.7%, okay, that means that their revenue, whatever amount of gold they sell, whatever it ends up being, if you stop the clock today, they will be selling their gold at 70 basis points more than they would have yesterday. So then if you want to know how that correlates to a valuation on the underlying stock, right? You take that increased amount of earnings and you apply the multiple to it, the acceptable multiple for the sector. Right now, the market would have you believe the acceptable multiple for that sector is like 6 or 7 times earnings. But even then, do it, right? Go 6 or 7 times earnings. Well, what it's telling you is that the gold miners should be up more than 1% versus 70 basis points on the gold. So one of the things that we've been talking about is despite the great run gold miners have had, I think people are forgetting at the end of last year. As a matter of fact, I want to say from September to December, if I remember correctly, gold was flat and miners sold off like something like 15 to 20%. Okay. So people are like, oh, it's outperforming this year. It's just catching back up what it sold off last year when it shouldn't have, right? Because gold was flat, miners were down 15 to 20. So you look at gold versus miners going back to January 1 of last year, carry it through to today, despite the fact, you know, S&P's down, 6% on the year? GDX is up 41. But it's actually cheaper than where it started the year at, especially if you're looking at gold and you're looking at, you know, assigning a multiple to it. I still think this is like the most obvious underinvested sector of the market that I see right now. And it might be one of the most underinvested, unrespected parts of the market I've ever seen. And you know, if you guys have been listening to me for a long time, man, I'm not a gold bull all the time. I know that it's right when it's right. It's right. Now, the one thing I would say is if you're looking to get into gold, do it gradually over time. If you're looking to build positions in gold miners, do it gradually over time. This gold is not going straight to 8,000. Okay. And the one thing, do I love all the fundamental drivers? Yes. I love everything about what's going on in gold, the gold mining sectors. I love how ridiculously stupid cheap. Just to give you an update too. Right? Let's see here. If you go back to 2011, yes, the all-time high on GDX, just to keep for those scoring at home, is 59. That was with gold at 1900 and oil at 90. Today, GDX is 20% shy of that mark at $50 a share, with gold at 32.50 and oil at 60. I think that tells you all you need to know. So anyway, look, tariff news coming out. Doesn't surprise me that they backed off on those tariffs a little bit. Got to continue to see the way that stuff sorts out. Obviously, we didn't get any big news on that today. So got to continue to see the way that stuff plays out. But I just, you know, I don't think it seems very obvious. The other thing that we keep seeing is on up days like today, let's go through and check this. Because one of the things we want to keep watching, guys, is keeping an eye on these trends, meaning how are foreign markets performing in relationship to the U.S.? Okay, so you look at today, it's still like we were saying. You got the DAX, the FTSE up 2.3, the CAC's up 0.86. Oh, excuse me, FTSE's up 1.41. The DAX is up 1. You see the European markets are ripping. Let's see how Asia was looking. Asia all up 2% in the Nifty 50, which I think is Nikkei was up almost 1%. Shanghai was not up big, but up 0.15. Again, on days when we're up, all the international markets up more. On days like today, when we're negative, all the international markets had really good days, up 1%. And I think that this is the beginning of the closing alligator jaws, guys. You've gotten we are coming off the most overvalued U.S. equity market compared to the rest of the world in history. Now you got a reason to move money out, like we've been saying since January 1. And you're seeing the price action confirming all this. It seems really obvious to me. And what does it mean? Am I telling you to go all? No, again, diversify. The United States isn't the only game in town. And oh, by the way, the stuff outside of the United States is at ridiculously cheap prices. I mean, it's driving our outperformance on the year. I think we're edging up toward 5. I think we're about 5 on the year now, something like that in our value portfolio. So anyway, our momentum portfolio is lagging. It's slightly down on the year, not much. But holding up better than the market, doing what it's supposed to do. But no, I keep licking my chops, guys. I think it's the same old story that it's been. And I think now is the time to be taking advantage of value, and in all of its different forms and all of its different locations. And where will I see that? I don't think it's wise to judge a complete market, and you don't want to do that. But, we were talking about it. When's our key to get back here in the United States? I don't think we're looking at it like that, right? Like a market timing thing. But, I told the guys, I go, look, this is really easy for me. There's a ton of great companies I'd love to own in the United States. And I can name several of them for you. Costco, NVIDIA, there's a bunch, right? I got to get down to, Microsoft. I'd like to get another crack at Microsoft, not at these valuations. There's a lot of stuff. But I think that this is where we've got to think like traditional asset managers. When are we going to buy it? We don't know, but we'll buy it when the price is compelling. And when you look at the backdrop, it's not. And that's my biggest issue, right? When I look at the backdrop today and I start looking around the rest of the world, I find a lot of stuff that is compelling. I find a lot of stuff that I've actually got to exercise some discipline not loading up on, right? Like our nat gas, beautiful nat gas company, one that's paying us 13% dividends, one paying us 9%, pristine balance sheets, right? I got to find stuff like that in an uncertain environment. What I have zero interest in is going and buying companies that are growing at 25 to 35% a year and trading at 70 times earnings, especially in a market like this, right? I mean, those things will get hit, and they already have, and they will get hit more, and they will get hit harder, and they will go lower. And now is not the time to be playing that speculative game. That time is over. So I think it's all about value, all about fundamentals. We probably sound like a bit of a broken record. The one change I will say is we have not owned oil in any size. We've had 1 or 2 positions. I don't think we've had, I think we've averaged about 2.5 or 3% exposure to oil over the course of this year. Oil is a tough one, guys. I think that Trump is really getting the Saudis to participate and play ball. And I think he's getting other producing nations to participate and play ball. And I would expect to see greater opportunities in the future to leg into oil names cheaper. Nat gas is a different story to me because of the different role it's going to be playing going forward. But not a lot of oil exposure here. And I'll continue to say, we got to keep spread out, stay diversified. Also, we're closing up here, but also make sure you're paying attention to the new content, right? We're posting the shows every single day now on YouTube, on Instagram, on Twitter. per usual, we've been on Twitter for a while. TikTok, we're posting clips. Darren, the fearless millennial, he's modernizing us. He's bringing us into the information age here. And if you ask me, I think he's doing a hell of a job. So anyway, but you don't want to miss all that stuff. So you can get us on YouTube and all the different sites. Just Know Your Risk Podcast. Look that up. Google it. That'll pull us up on YouTube. If you want to go to the website and subscribe to the podcast, that's still knowyourriskradio.com. We'll get that changed here. It's one thing at a time. But yeah, check out the new content, check out the videos, and hopefully you guys are enjoying the new formats as much as we're enjoying making them. So anyway, have a wonderful evening. We'll see you again tomorrow. You're listening to Know Your Risk podcast. Download and subscribe at knowyourriskradio.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.